Hey guys, it's James Dainard. You may have seen me on the new podcast, On the Market. So right now we're actually in Bothell, Washington at our recent flip house that we just completed. We partnered with Ashley Kerr from BiggerPockets Real Estate Rookie, where she was the passive investor and we were the operators. As an operator, we sourced the deal, we underwrote it, we pulled the comparables, we put together the construction plan. We then lined up the debt for the financing, how we paid for the property. We implemented the construction process, managed the contractors, lined out the subcontractors, and designed the whole flip, and we're handling the disposition, selling the property. Ashley, as the passive investor, put up all the capital in the project, and then she is getting a portion of the return at the end of the project. So why would Ashley want to be a passive investor in one of our flip properties? Well, the reason being is she's an active real estate buy and hold investor. She owns lots of rental properties, she owns different types of businesses, but she hasn't flipped a lot of homes. She also was sitting on a lot of capital and she wanted to make a higher return. So instead of going out and trying to buy that next flip property, learn the processes herself, she was able to flip a home all the way across the country with us. She put up the capital and now she's gonna make a large portion of the return, whereas we're doing all the hard work.
Only problem, I bought it from a fake seller.
James Dainard just walked over to my desk.
If you skip the first 3 steps, that's the easiest way to lose money. So when I'm wearing the passive investor hat, there's been 3 different types of operators that I'm usually working with. There's tons of them out there, different types of deals that you can invest in, but the 3 ones that I am most active in is a development project, where I'm working with an operator or a builder, they're sourcing the dirt, they're permitting the process, they're taking it all the way through plan review, and then they're handling the build and the resale. And I'm taking a more backseat approach on that. Typically those deals take about 2 years to 3 years to complete out. The other type of operators that I've invested in, or what I've invested in with Kara Beckman right now, is a fix and flip operator. The reason I like fix and flip operation deals is the time frame is a little bit shorter. On a development, it's about 2 to 3 years. On a fix and flip, your average duration is about 9 months to 18 months, depending on the size of the project. Typically, the deal sizes are a little bit smaller. There's less cooks in the kitchen. In a big development site, I may be investing in a project that has numerous types of investors, numerous different cooks in the kitchen. But with a fix and flip, like with Kara, I was the sole investor, so it's more of a partnership rather than just investing in a large project. I do like that because it gives me a more personal relationship with my operator rather than just being an investor in a big pool of funds. The third type of operator that I'm typically working for is an apartment syndicator. These are longer term investments. Remember, with a fix and flip, it's usually about 9 to 18 months. Development is about 24 to 36 months. But with apartment syndication, it can be 3, 5 years, or 10 years that you're gonna be investing your money. The reason I'm looking in those type of investments as well is because it's a different type of asset class. This is more for long-term hold, a steady growth, a steady return, and it gives me additional tax benefits. Besides vetting your operator, you need to vet the structure of the deal. Operators will propose all different types of structure, all different types of ways that you can make a return. The 3 different ways that I'm really familiar with when structuring these kind of deals. The first one is an LLC purchase. That's where you're actually forming a new LLC and a new entity for that specific investment. When I did my passive flip with Kara Beckman down in Scottsdale, Arizona, that's actually the way that we did it. We found the investment. We formed the LLC where I'm 50% owner, she's 50% owner. We then titled the property in that property. I lined up the debt on it. I provided all the down payment and the capital to close. She's running the project and we own that project 50-50. So in the structure, no matter what, she owns 50% of the title, I own 50% of the title. The second way that is very common for an operator to propose structure is a joint venture lending agreement. That's where I actually would come on as the lender, provide the financing, I'm gonna get a pref return on my rate, and they're gonna give me a portion of the profit or the equity at the end of the project. And the third way that I like, because it's the most simple way, is a joint operator agreement. So in this project that we did in Bothell, Washington with Ashley, that's actually how we structured the whole thing. As an operator, it made it very easy for me to go get into that next deal. I found this property off market, I was able to secure it with a purchase and sale. I was able to get all the inspections done, get the budget done, go through all my underwriting, and get ready to close, and then go talk to potential passive investors to be the investors. I still closed on the property in my name. The property is titled in one of our LLCs. This allowed me as an operator to get the debt that I'm used to getting. If I added in a second a second owner, a passive investor like Ashley, it can make things a little bit more complex. My lender might want to know who she is. She might have to get pre-qualified, and it can slow the deal down. So for us to keep things moving forward, what we did is we closed in our name. We lined up the debt. Me and my business partner are actually the signers on the debt, not Ashley. So she actually has no financial risk to the loan. The operators do. Prior to closing the property, we had Ashley sign a joint venture agreement that dictated the terms of the deal. It also gets recorded against the title, so she's secure. So a joint operator agreement is good because it secures the terms of the deal, it secures the investor to the deal, but it also still allows the operator to do what they need to do to keep the project moving forward. As a passive investor, when I'm investing in other people's projects, I want to make sure I'm secure, but I also don't want to get in the way of my operator, and I need them to run that project efficiently. So as you can see, structure matters. The agreements that you're putting in place on the property tells you how you're going to be secured, whether it's a joint venture or an LLC agreement, etc. But also the structure of the return matters just as much. How are you going to get paid? What is the return that you're going to be getting? These are all going to dictate whether it's worth it or not to invest in that next project. So when you're structuring these deals, things that you want to know or things that you want to ask your operator is how do they pay out the returns? Are they paying you a pref return with a portion of the equity? How much of that equity are you getting? Sometimes you could be investing 100% of the cash in the deal and only getting 10% of the profit. So you need to know these terms. What kind of fees do they charge? There's nothing wrong with an operator charging fees. That's normal. These guys are running a business. You're investing in their business. They need to maintain that business and make income. So common fees the operator charge is one, an acquisition fee. They're going to typically charge 2 to 3% of the purchase price as a fee. The second thing they charge is a debt acquisition fee. Many times the operator makes half to a point for lining up the loan. This is for their services of finding the right lender, getting the right structure in play, and they're being compensated for that. The third type of fee that's very common is a construction overhead fee. Many times an operator is going to charge you 10% to 15% of the total balance of the construction project. This allows them to have project managers, superintendents, guys that can help babysit the project and help protect your investment. Other types of fees are property management fees. If you're investing in an apartment syndication, typically the operator is going to charge the property management company or run the property management to operate that deal. I personally prefer if an operator is actually in control of the property management company rather than outsourcing it to a random third party. And lastly, what's usually common is a disposition fee. So when we're selling this project for Ashley and our flip in Bothell, Washington, we are actually getting paid a 3% fee on the disposition. This pays my team, it allows us to sell the property, and it keeps my employees paid while get the property sold. But you always want to understand these fees and whether they're reasonable. If I'm interviewing a new operator and I'm looking at their fee breakdown, again, there's nothing wrong with them charging fees throughout this, but if they're absorbent fees, I'm going to get a red flag. If this operator is selling me a construction project and they're charging me a 30% markup on my construction, I'm going to be a little bit concerned. It could allude to that they're trying to artificially manipulate the return and just get you your anticipated return rather than give you more upside in the deal. These will give you indicators on how efficient they're being ran and whether they're overcharging you or whether they're trying to manipulate the return. These are all things that I look at when I'm vetting my next operator. So after I verified how they're going to structure the deal and what kind of fees that they're going to be charging me, there's 5 other things that I always want to know about my operator before I invest in them. The first thing is I want to know what their experience is. How long have they been doing it for? Are they recently new? Have they gone through any kind of downturns? What kind of real estate experience do they have in general? How many projects have they completed? Which ones went amazing? And I also want to know which ones are bad. As an operator myself, I know that not every deal goes perfectly and it's up to the operator to kind of bob and weave and get the deal back under control. I want to know all those things. I want to make sure that they have the know-how to protect my money. The second thing I want to do is review their financials. What kind of liquidity do they have? Do they have any kind of wealth themselves? As an operator, we are very active investors. We have lots of properties in the state of Washington. We have to keep a certain amount of liquidity there. If investors are investing in one of our deals, they know that we are sound financially. It's not about just the project or the amazing deal we found. They're investing in us as an infrastructure as well. So make sure you're verifying their liquidity, how long they've been in business for, what kind of income they have, and what kind of also liabilities they have, so they're not gonna run out of any kind of capital or have money problems during your project. Before we get into our third thing, if you like what you're hearing on BiggerPockets, make sure you like and subscribe below. The third thing that I wanna verify is what's their operations. I wanna go physically go down and see what's going on. I don't wanna just go off of pictures or a portfolio that they sent me or a package that they sent me. I wanna go see the brick and mortar myself. So before I just invested in that project with Kara Beckman down in Scottsdale, Arizona, I flew down there and met with her. I didn't just look at a project that she was doing, I went and vetted her operations. I went and looked at 5 projects that she was working on, how efficiently they were going, what kind of budgets they were having, and it made me feel very comfortable to invest with her. The fourth thing that is very important is making sure that they have the right paperwork. If I call up an operator and I'm talking to them and they find an amazing deal, the return looks good, they show me their experience and that they've done a lot of different projects, I've gone down and looked at it, but then they send me off the paperwork and it's a little bit suspect, it's gonna be a major red flag. Each state has its own set of guidelines and laws. When you're investing with an operator in a different state or even your own state, you need to make sure that the agreements are legally binding. If they're sending me off paperwork that's sloppy, that may not be contractually right, it's gonna be a huge concern. So anytime I'm looking at paperwork, I make sure that an attorney from the local area looks at it. The paperwork is what secures you on your investment. It dictates what kind of return you're gonna get, how secure you are, and how the process is gonna go. So make sure that it's legally binding. And lastly, the thing that you need to do is verify your operator. If you're investing in some new type of project, like maybe you're a fix and flip person and you're buying it into a development operator's deal, you need to make sure that you understand their underwriting at least. It's not the same type of valuation. Or if you're in a different state, same thing. Houses sell differently in different areas. So things that I do to verify my operator's underwriting is I work with a local broker in the market. If I'm looking at investing in Arizona, Atlanta, or any other market, I want to have a broker with boots on the ground that can actually look at comparables. In addition to, I like to find an appraiser in the area. I can hire an appraiser and have them look at that asset and verify some numbers based on local market conditions for a $500 fee. To pay $500 to protect thousands of dollars that I'm investing in that deal is worth it all day long. So you need to make sure you're able to verify their numbers, verify their performance, and verify their comparables before you invest in that deal as well. So before you invest in that next deal with the next operator, make sure you take all these steps to protect your investment. Remember, there's all sorts of different types of deals out there, there's different types of structure, and there's different types of qualities of operators as well. Find that experienced operator. It protects you better. The more experience they have, the more they know how to navigate different market conditions. For example, like right now, we have interest rates that are spiking and it's causing changes in market conditions fairly rapidly. You want to make sure that your operator can move through any kind of market condition and they have the know-how to do it. Finding the right operator doesn't mean investing in your best friend or somebody that you know really well. It's about investing in the right process. Don't just go find the next influencer online because they have a bunch of followings. Find the guy that has the best systems in place and knows how to protect your investment. So thanks for tuning in to our video on how to vet your operator on BiggerPockets. Like and subscribe below, and check me out on Instagram at JDainFlips and on YouTube at Project RE, and we will see you guys next time.